Hello and welcome to this week's edition of Econoday Unplugged. It's Tuesday, the 14th July 2020. Mark Pender is stateside and I'm Jeremy Hawkins in London. Last Friday, the People's Bank of China signalled it has started to wind down the emergency easing packages introduced to combat COVID-19. Facilities covering relending, rediscounting and excess liquidity injection will be retired and credit supply will be kept in line with the pace of economic recovery. However, just a couple of days later, the World Health Organization reported a record daily increase in global coronavirus cases, with more than 230,000 new infections. And that means that, in contrast to China, by and large, fiscal and monetary policies around the world can be expected to remain geared towards providing substantial economic support. And Mark, I see there was additional evidence of US efforts to do just that in a huge June budget deficit announced just a few hours ago.
Yes, it was pretty amazing. The one thing before we have to understand with this budget that this was for June. That was an $864 billion monthly deficit that brought the year-to-date deficit to, what is that, about 9 months into the fiscal year, to $5 trillion, almost on the dot. That's up 50%, up 267% from the year ago comparison. But this is the point I wanted to make, that the individual tax season has been pushed back here in the U.S. from April to July. Mm-hmm. And that's right now. So individuals now are paying their taxes. So that comparison, that 267% comparison, is out of kilter because it removes the biggest surplus month off the calendar, moved it to July. So there should be a little bit less of the trouble. But when you look at the graphs, it's astonishing, and it gets to this logarithmic thing when you're trying to make a graph. The prior years, the amount of increase in the deficit was extreme, but it was in a smaller range. Now, when you graph that prior increase just disappears, even though it was extreme at the time, compared to what we see now, which is this gigantic, massive, incredible.
If I remember rightly, and I'm sure you can correct me on this, but I think was it during the 2009, the global recession, and the deficit the entire year was only 1.4 trillion. Mm-hmm. So I mean, it really just underlines just how this thing has literally gone through the roof, be it the odd distortions here and there, whatever.
And it's also in the Fed's balance sheet. Okay, so the government is the fiscal side, which are mostly temporary or less permanent fixes or less permanent stimulus, as opposed to the Federal Reserve. When it adds to its balance sheet, that stays for quite a while. And it has gone to last I looked, it was about 7 trillion. So that's basically had doubled. And I guess in 2009 is when it first started to appear. It was about $1 trillion, and then it moved up from there to about the 4.5 trillion peak, I think, several years back before they started bringing it down. Now it's through the roof as well. How long can this go on? If it stops, there might be trouble for the financial markets. I don't think the Fed is going to stop, but can the government continue to spend money like this? As long as there's someone buying it, and the Federal Reserve is the biggest customer, or one of the biggest customers,
right? And
that's a little bizarre. And can they be the only customer? Well, that's pulling yourself up by your bootstraps, as they say. So that you wouldn't think that could go on, and we have an election year, and can there be another stimulus package put through? That remains to be seen. But so far there hasn't been any breakdowns in any auctions. That would be the first real, danger signal. Have you seen any bad auctions go off in Europe or anything like that?
No, I mean it's quite remarkable. You think the amount of money which is being borrowed by these governments, say pretty well all around the world at the moment, but auctions across Europe by and large have gone extremely well. As you mentioned, a lot of it's got to do with central banks, be it the Bank of England or the ECB over here, which are buying a load of paper at the moment. But even putting that on one side, it does seem to be the case that private sector investors are still struggling to find some kind of reliable or safe asset they can buy, which gives them the potential of at least earning some kind of capital appreciation. And yields across a lot of Europe are negative for out some way. But so long as we've got the economy in recession, doubts about how quickly we're going to emerge from the coronavirus, there's always a possibility we can see these yields go down even further. And if that's the case, of course, and you hold the bond, then you can make money on it.
Now, the ECB has a meeting on Thursday. Tell us what you're looking for, and also touch on quantitative easing.
Okay, yes, you mentioned so ECB meeting then also on Thursday, so it's July meeting. I don't think really anyone's expecting too much to be coming out of this, but we did see a big, well, by their standards, a big easing at the last meeting. That was when they decided to expand their so-called Pandemic Emergency Purchasing Fund, the PEP that most people call it now. That was introduced in March, and they increased it by some 600 billion euros to 1.35 trillion in June, and it's really,
and this is a temporary. It's called PEP, which is fun, right? But it's temporary.
Well, it's temporary, sort of. They said at the moment it's going to run through for as of last month. They extended it, so the earliest it can end is the middle of 2021. But essentially, it's going to remain in place until such time as they believe that the effects of the COVID-19 have been taken care of. And I guess really got to say it's currently doing most of the work. As I mentioned, this thing was introduced in March. As of the end of June, cumulative net purchases in the PEP stood at just over 365 billion euros. So it's really providing most of the additional stimulus on top of the rest of the quantitative easing. And by that, I mean talking about there's two other aspects to this. One, they have this so-called temporary QE envelope, which amounts to a total of 120 billion euros. And that's a flexible thing which will run through until the end of this year. And of course, they have their long-standing so-called asset purchase program, the old APP, and that's going to continue to run indefinitely at this stage until, well, at a rate of 20 billion euros a year. So there's a lot of money they're still sticking into the system at the moment, but the most flexibility they have, and really the sort of the bulldozer approach, I suppose, currently is this PEP, and that's what markets will be focusing upon. I think in terms of interest rates, they really made it pretty well clear that they don't see much value in taking interest rates down any further. So they've got what's become their key rate now, the deposit rate, which is at minus 0.5%. The main refunding rate, the so-called REFI rate, is at 0.0%. That, of course, for a long time really dictated where interest rates went. And at the upper end, the marginal lending rate, which doesn't actually do a great deal these days, that's at plus 0.25%. But as I mentioned, they really indicated that they don't believe now that cuts in short-term interest rates are going to offer any kind of use in terms of keeping longer dated yields down whatsoever. So it really all comes down to buying these bonds through the quantitative easing program.
Do you think they're going to increase any of their QE on Thursday or announce any lending facilities or anything like that?
I think given the fact that for once they actually exceeded expectations with their increase in QE at the last meeting, is pretty unlikely. I also think there's been some comments coming out of Christine Lagarde, the ECB president, over the course of the last couple of weeks or so, kind of intimating that they believe they've done a fair chunk now, and they need simply a time for that to have some kind of impact on financial markets and the economy. Now,
so monetary policy is at status quo right now in Europe. What about fiscal policy? And we have a big meeting on Friday. Is there a belief that should also be a status quo?
Well, that's a good point. And this is a big meeting, and and partly I think you can say that what comes out of this is going to at least have some kind of implications for what the ECB does further out. As mentioned, ECB this week, I think it's pretty unlikely we'll see anything, but that doesn't rule out some kind of additional easing, say probably through quantitative easing later on in the year. But as you mentioned, there is this huge meeting, an EU leaders summit taking place at the back end of this week, and this is where they'll be thrashing all the details of this so-called post-COVID recovery and resilience fund, which basically is the bailout fund they're trying to get agreed by all the EU leaders if it's going to actually come in fruition. Now, this thing amounts to 750 billion euros, which, to be perfectly honest, is not as much as it could be anyway. But as we've mentioned before, there's been this major sticking point with those who actually want to push the thing through, and those so-called frugal four members who still are extremely unhappy about, well, they think the size of the package is too big in the first place, and also they think it should all be directed through loans rather than the bulk of it coming through grants. And it's certainly not clear on the basis of what we've had coming out of, I think it was some Dutch comments earlier on this week. It still seems as if there's major disagreements about what shape this package should take. And I think were it to be the case, we come out of the EU leaders meeting Friday and Saturday and there's no agreement, then, well, a couple of things. One, I think it's going to be bad news for the euro because, again, it's just going to be signs that when push comes to shove, these politicians can't really get their act together and come out with a united front. And two, it's just going to add pressure on the ECB. Well, if fiscal policy is not to do the job, then monetary policy is going to have to do even more. So I think what comes out of this session could actually be important for Eurozone financial markets and the euro.
Well, for the investors and for the news people, how do you think the information is going to come out? You say it's a two-day meeting into Saturday?
Yeah, it kicks off on Friday. I think the announcement will either be Friday evening or on Saturday, and they'll issue a communique about what happened. So
do you think there'll be headlines coming out during Friday?
There may well be. Yeah, I mean, they always have a dinner after which quite often, if they want to, all of a sudden leaks are provided. It's so often the case now that, almost it doesn't matter what the meeting is. Various nuances are given out to members of the media or whoever it may be to the fact that it's kind of rare that markets are ever really, really surprised by what, fiscal policy or monetary policy does these days. They try to do the softly approach and make sure markets are ready for it. But yes, there will be an official communique which outlines what's going on.
And that's on a Saturday when the markets are closed or very
that's
illiquid.
Right.
So that's going to be a difficult.
It could well be, yeah. Certainly have to see. I suppose from a numbers side here, it kind of suggests it's still needed anyway. We had some industrial production figures today. These will be for May. Showed Eurozone industrial production on the month up 12.4%, which actually looks half decent, but of course it follows an 18.2% decline last time round, and it means, and it's levels as we keep iterating that are important now. The level of industrial production in the region is still 19% below where it was in February before the coronavirus struck. So the retail sales seem to be holding up a bit better, but I think the overall picture in terms of the Eurozone anyway is that although demand may be starting to re-emerge, output probably progressing rather more slowly.
Have you noticed that these percentage changes, the year on year, when you're comparing a June to a June last year or a May to a May last year, is about the same or in the same ballpark as the comparisons to February? And I guess that reflects what had been a very flat year, if not a little bit of a downtrend. So when we make the point we should compare it to February, but it's like a flat plateau that just all of a sudden fell into a gigantic crater. Mm-hmm. And so those comparisons are kind of interesting. And you get different looking slopes. You get this month to month slope is going straight up now. But then, it's like you were saying, the year-on-year slope, or compared to where we were in February, that is maybe not going any deeper, but it's not coming up very much.
That's right. I mean, certainly from the European side, I suspect your side might actually be doing rather better. But in terms of Europe, you have had some fairly spectacular monthly increases in production, depending upon which Eurozone member state you want to look at. But with very few exceptions, even though you've had a huge monthly increase, it is from such a low level that there's still an awful long way to go to get back to where we were. And I think, by and large, looking at the kind of survey evidence we've had for June and sort of some early calls from bits and pieces talking about July and business expectations and so on, yes, it looks as if the worst is behind us and we should see positive growth in terms of overall GDP for the third quarter. But I don't think there are too many businesses really expecting the third quarter to be that good. And certainly by the end of this year, I think in general, the supposition is that we'll still have Eurozone GDP significantly below where it was in the first quarter.
Business expectations. You had a report today, right? But before, we here in the U.S. we have this question now about closings and renewed closings in major states, major economic centers, and that has thrown up into the air. It hasn't affected the stock market, of course, but as far as your own ability to, your own forecasting, you don't know exactly. This is a big unknown. Now, it doesn't seem to be playing. The COVID doesn't seem to be playing out the same way in Europe or in the UK yet. Although you kind of wonder, like I say, a lot of the images we see here in the States are of people not wearing masks and clustered in small friendly groups, right? And is there a question now? Yeah, the business expectations number. I mean, did you see anything where maybe people are not as excited as they once were?
Well, I think it's safe to say that it's never safe in this kind of environment, is it? That's probably a ridiculous comment. But so far, on the basis of what we know, the trends for COVID are pretty well still going down. So they're heading in the right direction, which has meant that the reopenings we've seen pretty well across Europe so far don't seem to have caused any big problems. There have been a few clusters, notably in Germany, where there's a fairly major meat processing plant in North Rhine-Westphalia, which produced a number of cases, and that was met with an immediate localized lockdown. But outside of that, it seems to be the case that what has reopened has pretty well stayed open, and that's, of course, for those people who've got a forecast, at least gives you something to hang your hat on. But even then, around this, there's still changes taking place. For example, in the UK today, the government announced that face masks and coverings will be compulsory in English shops from the 24th of July. Now, there's been a lot of talk as to whether or not do you need to wear face masks or don't you? But it does seem as if some of the medical advice, certainly to the UK government, be it out of the World Health Organization or their domestic scientists, suggesting that if nothing else, it's sensible to do it. So I think there's still a good deal of uncertainty about how best you treat this thing. And I think there's genuinely a lot of concern about the risk of a second wave. And indeed, we've had some medical experts in the UK making noises just earlier on today to the effect that there's a real danger that there'll be a second wave in the winter time, and it will lead to even more deaths than we've seen, during the course of the current outbreak. So I think there's this. Sorry.
Yeah. Have there been discussions about if what a second wave that may be appearing right now in the U.S. means to Europe?
Well, I think, as always, we've seen from the way the stock markets react, when we do see the stock markets come down these days, it tends to be because there's been some particularly bad COVID numbers coming out of the States. Now, no, there's not by no means there's a one-for-one correlation on that. But typically when we've seen the European markets struggling, it's because they've seen bad COVID numbers from your side of the water. And that's interpreted as being bad news for global growth. And you overlay that with the ongoing fight we've got now between the US and China, of Hong Kong and everything else. And there's this unease, I think, still, which, had it not been, as we talked before, about all the liquidity sloshing around these global markets, then we might well have seen more of a knee-jerk reaction on the downside, to bad news than we see at the moment. It really does still seem to be the case that investors want to buy. It's a question of what they can find to buy. So good news is good news, whereas bad news, well, perhaps it's not quite as bad as it might have been, in other times. UK was disappointing today, I should say, while we're on Europe. We get, say, these monthly GDP numbers now, and for May it was up 1.8%, which if you start annualizing that, of course, it looks really good. But that follows the April decline of 20.3%. These are month-on-month numbers, and that in turn followed a fairly significant downward revision to March, which now stands at minus 6.9%. So despite May again, just comparing it with the pre-COVID numbers we had back in February, the UK economy is almost just over 23% smaller than it was just a few months ago. So we've got this indications of a recovery coming through, but there's very little in the European data in general, and particularly in the UK data at the moment, to suggest it's going to be V-shaped. And so having just talked quickly about global trade before, we've seen the pound under pressure over the last few weeks. One reason has been the fact that some of the numbers have been disappointing, and sterling certainly didn't like the May GDP numbers today. But also, we've just had news of a government U-turn regarding the Chinese telecom company Hauwei. That will now be banned from supplying new equipment to the UK's 5G networks as of the end of this year, and existing equipment will have to be taken out. I think it's by 2027. Now, this comes at a time, of course, when everyone's got an eye on these post-Brexit trade talks and wondering what the future is going to hold for UK international trade. And the UK itself, of course, is desperate to find new trading partners in case they don't get a new trade deal with the European Union. So another thing which seems to be upsetting that is another negative for the pound. Now, China currently only holds about 3, perhaps 4% of the total UK export market, but UK would like a lot more of that. But what this Huawei decision is certainly going to hurt relations with China on that front, and again, that could be bad news as far as UK trade is concerned. So there's quite a lot of issues, I think, for the pound, which continues to leave it one of the more volatile of the major trading currencies. Okay, what else have we got? I suppose quickly mention on China. It is quite a big week for them, culminating worry on the GDP numbers. What day are out? Thursday or out? Where are we? Thursday morning, aren't they? They're expected to see a fairly decent rise, about 9.4% on the quarter and 2.3% year on year. That'll be after an annual decline of almost 7% last time round. So in the first quarter, that's going to be important, I think, for markets, because clearly people looking towards China, particularly in light of the central bank's announcement, it will start to phase out some of these supportive measures it's been introducing to keep markets going. So if we were to see any kind of disappointment there, that could be disproportionately bad, I think, for equity markets.
We also had Chinese trade today,
yep.
And that showed improvement. So an increase in imports and also exports too.
Yep, we did see, as you say, I think where are we? Exports up 0.5% on the year. That was after down over 3%, and imports up 2.7%, and that was down after almost 17% on the year. So again, you're right. I mean, things are moving in the right direction. Just hope they can continue to move that way. But by the same token, I think last week when we had Brian on, we're talking about some of the problems with Hong Kong and who may actually benefit that, from Singapore potentially being one. Well, Singapore's economy now entered technical recession as it shrunk by a record 41.2% quarter on quarter in the second quarter. Now, it's got to be said that these numbers, I think, are largely built just on the April and May data. They don't have a lot for June at the moment, but that's a pretty big downturn. That said, Singapore's also spent the equivalent of fiscally about 20% of GDP trying to sort its economy out after COVID. So hopes are very much that we will see a rebound. But
they also win the award for the Econoday calendar for first out on a second quarter. It's a pretty report. It's a pretty, like you say, it's it can't include too much of June, but it is, the UK has its monthly report, and we're up to May, April and May, but Singapore was out early. They weren't hiding anything. So,
in fact, it's an interesting question because there's so much focus now upon the very latest economic information. Now, for the UK, the GDP was only May, but at least that's whole economy for May. Is there any talk stateside of introducing monthly GDP accounts? Well, not accounts necessarily, but monthly GDP data.
No. The typical conversation of data in the U.S. is that it's overextended based on based on.
For someone who writes them all up, I believe it when you say that.
I believe that, but actually, the government funding for it. So to create, they're always it's always on the margin. Which ones are they going to cut back? But they never do really. But it's difficult to get any kind of new project going. So the U.S. is kind of slow on the GDP, which doesn't come out. We'll get the first estimate for the second quarter at the end of this month. It'll be interesting to see what that number is. I imagine they're going to say, what do you think? Minus 10% annualized for the second quarter? I mean, that's just a rough guess.
What?
But
for where? For,
for the
your
U.S.? Yeah. What do you
Your guess is better than mine, but
probably not.
Well, don't say that. Don't quote him on that. I mean, Europe's going to be bad. We know that. I mean, because of course, we tend to look at it quarter on quarter over here rather than annualized. But I would guess second quarter for Europe's going to be down something like 25% plus. It's going to be a really bad number. And UK currently is tracking about minus 20%.
Even
so
it's GDP. You said the sterling went down on that. So what was it that disappointed again?
Well, the markets were looking in terms of the monthly numbers for May. GDP was expected to be up, because we've had at least partial reopening. The worst month was April, so May we should, starting from a very weak base, we should get a semi-respectable number. So the market expectation was up 5%. So less than 2% was certainly disappointment. I mean, again, we can say that these numbers are all over the place at the moment, but nonetheless, investors want to see better numbers, and a miss like that certainly wasn't taken well.
And how did they use the 3-month to 3-month in this monthly report?
Well, if you believe the Office of National Statistics, which of course we all do, then as far as they're concerned, when they're putting together the latest month's numbers, they're working off really just output numbers. They don't have the expenditure figures. So the whole thing is based on output. And like anything else, the early survey data are partially reliable, but it tends to be revised sometimes quite a lot. So they stress when you're looking at really kind of the underlying developments, you should be looking at this rolling 3-month change. Now, if we do that for the UK, so in the 3 months to May, compared with the previous 3 months, total output was down just over 19%.
Because that's picking up April and March.
It's picking up the really bad months. So I mean, clearly, yes. I mean, it's all real looking at that, but by the same token, because those months were so bad, it kind of biases a view down of where you are now, which comes back to this, the need for early data. But then going back to GDP, I suppose the closest thing you've got now is what are these? I know you don't like them, but these regional nowcasts. You get out a string of Fed banks.
Yeah, that's true.
But I know you don't place much weight on them, do you?
Well, I don't know if I.
Or does the market?
Well,
I should ask you.
No.
Does the market?
Well, actually, I don't want to talk too much about business here, but in the past, I've supported Econoday running those. But, given the great vast quantity of data that we already run, there wasn't any enthusiasm in the staff to to pick them up. So that's kind of how that dropped. But there's several of them too, and they're all done by the feds and stuff. So it's
but they can differ quite a lot, can't they?
They can, yeah. Well, especially now, right?
Yeah.
So because you just have to take blind guesses at some of these numbers, of course.
Yeah.
And all the seasonal adjustments are going to be completely almost useless. They're going to be taking up these little nuances of and what's happening now is this, and that's going to affect future adjustments too. What do you do with some period like this?
Yeah.
And does it get folded into future numbers? Maybe it shouldn't, but that's another issue.
One for the stats guys, yeah.
Yeah.
Okay, well, I see we're probably talking far too long here, so just quickly wrap this up with central bank stuff. Nothing of any great note. Bank of Japan expected later on today. No change expected there. Bank of Canada on Wednesday. Similarly, no change expected there either. So let's end it there for today then. We'll be back next week. And in the interim, all the key market moving data and events can be found in Econoday's global economic calendar as usual. From Mark and myself, thanks as ever for listening. Stay safe and we'll see you next time. Bye for now.